Ever wondered what the difference is between index funds, mutual funds, hedge funds, and ETFs? You've heard all these fancy terms thrown around by investors, right? But here's the truth. Understanding the difference between them can literally save you thousands of dollars and help you grow wealth faster. So today, I'm going to break each of them down in simple, no jargon language, so you'll finally know which one's right for you. Let's get started. Welcome to Artificial Finance Clarity, where finance is made simple and wealth made possible. If you want to understand money, investing, and financial freedom in plain English, hit that subscribe button and join our growing community of smart investors across America. Section 1. What are mutual funds? Let's start with the mutual fund, the most common and oldest type of investment fund. A mutual fund pools money for many investors and invests it in a mix of stocks, bonds, or other assets. It's managed by a professional fund manager who decides where your money goes. Pros: super easy to invest in. Even beginners can start with just a few $100s diversified, meaning your risk is spread across many investments professionally managed. You don't have to pick stocks yourself. Cons: high management fees. You might pay 1% or more every year. Tax inefficiency. When the fund sells stocks, you might owe taxes. The manager's decisions might not always outperform the market. In short, mutual funds are good for beginners, but they're not always the most efficient choice. Section 2. What are index funds? Now let's talk about the smarter cousin, the index fund. An index fund is also a type of mutual fund, but instead of being managed by a person, it's managed by a computer that tracks a market index, like the S&P 500. So if the S&P 500 goes up, your fund goes up too. Pros: low fees, no expensive managers needed. Diversified, you own pieces of 500+ companies instantly. Consistent returns that often beat most managed mutual funds. Cons: you'll never beat the market, you'll just match it. You still face market ups and downs. Fun fact: even Warren Buffett says that most investors should just buy an S&P 500 index fund and hold it long term. So if you're serious about building wealth, this might be the best place to start. Section 3. What are ETFs? Exchange-traded funds. Next up, ETFs or exchange-traded funds. Think of ETFs as index funds with superpowers. They track an index just like an index fund, but you can buy and sell them like stocks on the stock market. Pros: you can trade anytime during market hours, lower fees than mutual funds, great for both short-term and long-term investing. Tax efficient, you pay small brokerage fees when buying or selling. Some investors trade too often and hurt their returns. So if you want flexibility, control, and low costs, ETFs are often the go-to choice for modern investors. Section 4. What are hedge funds? Now let's talk about the mysterious one, hedge funds. These are exclusive investment funds for the rich. Usually, available only to accredited investors, people making $200,000 plus a year, or worth $1 million plus. Hedge funds use complex strategies like shorting stocks, using leverage, or betting on market trends to make high returns. Pros: can make money even when markets crash. Managed by top professionals. Cons: super high fees, 2% annual fee, plus 20% of profits. Risky and secretive strategies not accessible to regular investors. In short, hedge funds are for the wealthy. And for most people, index funds and ETFs are much smarter, safer bets. Section 5. The quick comparison table. Let's compare them quickly. Type: managed by fees, risk, liquidity. Best for mutual fund professional. Manager: high, moderate, end-of-day beginners. Index fund: passive, tracks index, low market risk, end-of-day long-term investors. ETF: passive, tracks index, very low market risk, anytime, all investors. Hedge fund: active, manager, very high, high limited, wealthy investors. Section 6. Which one should you choose? If you're just getting started or want long-term low-stress growth, go with an index fund or ETF. They're low-cost, tax-efficient, and used by the world's top investors. Mutual funds can still work if you prefer professional management, but hedge funds only if you're ultra-rich and ready for big risk. Now that you understand the difference, here's your next step. Choose one index fund or ETF, set up automatic monthly investments, and forget about it. Let compound interest do its magic. If you found this video helpful, like, subscribe, and share it with a friend who's ready to start investing smarter. And remember, at Artificial Finance Clarity, finance made simple, wealth made possible. Thanks for watching. I'll see you in the next one, where we'll talk about how the rich invest differently than everyone else.